Welcome back. This is Unit 2, Part B. So just as a reminder of where we were looking at national income statistics. And we are saying that there are a few ways in which we can compute this. We can look at the gross domestic product. We can look at the gross national product. Or we can look at the net national product. Remember, GDP measures the total output, which is the total production within our economy. And this production is based on the factors of production which are local to the country. And usually, we're looking at this from some time horizon. And the time horizon is usually 1 year. It's important to note, though, that the concept of market price and factor cost has to be taken into consideration. Because market price tells us what the consumer pays. And what the consumer pays can be different from the factor cost in terms of what the consumer pays might include the indirect tax, such as GCT, which creates an increase in the price of the product. Or it can include subsidies, which would denote a decrease in the price of the product for the consumer. So both of these are from the consumer perspective. Factor cost, on the other hand, is what does the seller earn? So although the seller collects the indirect tax, that is not their income. That is actually sent to the government. But in terms of the subsidies will be a part of what the seller earns. The example I gave was there's a cost of a vehicle of $6 million and somebody gets a concession from the government. It means that the person is going to pay $5 million, but the government is going to pay $1 million. So in total, the seller would receive the $6 million. So we're also saying that the equation, the basic equation that we're working with, is that the level of output or production within the economy is going to be equal to the amount of expenditure in the economy, because everything that is produced is going to be purchased. That's the assumption. Additionally, we're saying that in order to generate the outputs, then the firm is going to make use of the factors of production, and in return, they are going to provide some wages, some rent, some interest, and some profits to the owners of the factors of production. Therefore, income, is going to be the same thing as being the output. And we had looked at a quick example where we had done GDP, which is GDP in terms of the output, based on the information here. And we had come up with some figure that would denote the total production within the economy based on the data that we have. So this is GDP, and remember that is at the market price. Whenever we are dealing with prices in whatever shape or form, then we are looking at market price. And just to reiterate, market price can be adjusted based on the indirect taxes as well as the subsidies. Now, we did say that there are 3 ways of computing GDP. We have looked at one way, which is GDPO. So there are 2 others that we want to look at. So we have already looked at GDPO. So we want to have a look at GDP through the eyes of expenditure and GDP through the eyes of income, factor income. So let's have a look at our example. So we are told that the state of the economy is defined by the table below, where we have a set of items. And we are being asked now to compute gross domestic product at market price, gross domestic product at factor cost. And then we're also talking about gross national product and net national product. So let's not talk about those as yet. Let us compute gross domestic product, or GDP, because we have already spoken about that. So we want to find GDP. And the question that we're asking here is, well, which formula are we going to use? What type of GDP computation are we going to leverage? So we have to look at the question and determine what data we have working with. So we know that for GDP, we're talking about price and quantities. A quick survey of the table, we're not seeing any price and we're not seeing any quantities. Therefore, GDP-O is not appropriate. Well, what about GDP-I? For GDP-I, which is income, we are looking at things like wages, rent, profits, and interest. Just quickly looking through the table, you would realize that we're not seeing all of those elements. For example, we're not seeing wages. That's not there. We're also not seeing profits. So by the process of elimination, it could not be GDP-I either. So therefore means that we are left with GDP-E, expenditure. And remember, expenditure is also going to be at market prices. So what's the formula for GDP-E? It's the level of consumption by the household plus all the investments which would have been done by the firms, plus whatever spending has been done by government, plus how much was spent in terms of exports and how much was spent in terms of imports. And we find the difference between the two, which ends up giving us the net exports. So let's now put in some figures based on what we have in our table. So the consumption here is 30 plus. What is the investment? It tells us that investment is 15. So we have 15 plus. We now need to find the government spending, which we are told here it is 20. 20 plus. We need to find the net exports. So do we know what the export is? Well, the export is 50. But because it is the net exports, we have to subtract the imports from it. So minus, what's the import? It is 10. And what we end up with here is 30 plus 15 plus 20 plus 50 minus 10 gives us 40. So 40 and 20, that's 60. 60 and 30, that's 90. 90 and 10, that's 100. Plus the 5, that gives us 105. So therefore, we are saying here that GDP, based on the expenditure approach, is going to be 105. All right, so that's a good start. Now, it's asking us also for GDP at factor cost. Now remember, factor cost is based on the income that has been generated. And therefore, there are some components that might have to be adjusted based on the subsidies and based on the indirect taxes. So let's have a look at our table. And when we look at our table, we realize that we do have some values for indirect taxes, and we do have some values here for the subsidies. So we need to make some adjustments for that. So here we go. We are going to find GDP. So GDP at factor cost. And we're going to say that this is going to be equal to GDP E. By the way, this should actually be GDP I, I for income at factor cost. So this is going to be the GDP E plus taxes minus the subsidies. All right. So, no, I've misplaced the symbols. We should be subtracting the taxes here, and we should be adding the subsidies here. So let me redo that so that it's clear. I think I'll just do it below. All right, so to provide clarity, let's go back to our definition. So GDPI MP is equal to this formula. So let's just write it below. So we have GDP I at market price is equal to GDP I at factor cost and then we're now going to account for the taxes and the subsidies. So we would add taxes and we would minus subsidies. So we add the indirect taxes and we subtract the subsidies. All right, so this is the formula that we would use to convert from GDP factor cost to GDP at market price. So what do we know? We know that we have a measure of GDP here, which is expressed in terms of market price. And so what we want to do is to move from market price so that we can understand what is GDP at factor cost. So there might be some components that has to be adjusted. And the components in this case are going to be the indirect tax and the subsidies that we need to account for. So let's just use a little bit of math because we want to move from GDP at market price to GDP at factor cost. So if we're trying to find GDP at factor cost, which we don't know, so what we're going to do is to move everything over. So we have GDP I at the market prices. And then we want to remove taxes and subsidies from this side of the equation. So in order to remove it from this side of the equation, it means that we need to add taxes So that would cancel that. Sorry, we need to subtract taxes. So we need to subtract the taxes. And we need to add the subsidies. Now remember, in order to keep the equation consistent, whatever we do to one side, we have to do to the other side so that the equation can balance. It therefore means that we are going to end up with GDPI at market price minus the taxes plus subsidies that's a D is going to be equivalent to the GDP I at factor cost. So let us put in the values now. We know that GDP at market price is 105. We computed that based on the expenditure model. So we want to subtract the taxes, which is 15, and we want to add the subsidies, which is 5. And that will give us the GDP at the factor cost. So therefore, this implies that GDP I at factor cost is equal to 105 minus 15 plus 5. And that would give us, let's just punch it in on the calculator. So 105 minus 15 plus 5, that gives us 95. So the question that you should be asking is, if output is equal to input, is equal to expenditure, then why is this different? Why is this value here, the 95? Why is this value here different from this value here? And this leads to what we were talking about earlier. We're talking about the fact that we need to make conversions between the factor cost and the market price. So in the top one, the market price, the values that we got were telling us what the consumer would have paid. And this means that the whole taxes and subsidies would have been embedded in that. So in order to go back to factor cost, then what we need to do is to make the adjustments in terms of the taxes and the subsidies. By the way, just for completeness, the reason why we subtracted the taxes is because we wanted to put taxes to 0 on this side of the equation. And the reason why we add the subsidies is because we want to get rid of the subsidies on this side of the equation. And remember, what we do to one side of the equation, we have to do to the other side of the equation. Therefore, the taxes and the subsidies, how we treat them on this side of the equation, we're going to treat them in a similar manner on the other side of the equation. And that's why we ended up with what we got. All right, so I think that should be clear in terms of understanding how to compute or how to move between factor costs and market prices. The other thing that we need to compute here are gross national product and net national product. And we want to look at these at factor cost. So let's get some definitions out of the way. Whenever we talk about gross national product, we're talking about the income that is earned by the resident. And it does not matter where residents are located within the world. For simplicity, we usually use the term citizens to think of residents, even though that is not the economic definition of the word. But for simplicity, we can just use it as a reference point. So we have some Jamaican citizens who are abroad, and they are going to generate or earn some income. GDP would not account for that because GDP is looking at the total production that has occurred by leveraging the factors of production within the local environment. But if we want to look at how well we are doing as a nation, then what we are saying is it might make sense for us to look at where our nationals are and what kind of contribution they are making, because probably that money that they are earning is coming back to the local economy to assist in the local economy. So therefore, we end up with our formula that says to compute the gross national product, then what we need to do is to have an understanding of what the GDP is. And then we need to account for the net factor income that is generated abroad. So what is net factor income from abroad? It is the difference between what residents earn from abroad, and then we take away from that what the foreigners who are here would earn locally, or what foreigners earn locally within our space. So the difference between that gives us the net factor income that is coming from abroad. And one of the things I want you to bear in mind is cash flow. Where is the money flowing to? If the money is flowing outside of the borders, then it means it is leaving our economy. But if the money is coming into our borders, then that means it is coming to our economy and it is enhancing our economy. So we want to find the gross national product. And we said that the gross national product is equal to GDP plus the net factor income from abroad. Which GDP do we need to use? Well, this says we need to find the gross national product at factor cost. Factor cost. So therefore, it means that the GDP that we need to be using here is the GDP at factor cost. So let's just use some simplified notation. So we want to find GNP at factor cost. And this is going to be the GDP at the factor cost plus the net factor income from abroad. So what do we have here? Well, we already know what the GDP at factor cost is. We just computed it above. It's 95. So what we now need to determine is what is the net factor income from abroad so that we can add that. So when we look through our table, it tells us that there is the net property income from abroad is 5. So therefore, let's just add the 5. Note in this case, we do not have any money that is flowing out based on the information that we are given in the table. We only have money that is flowing in. So therefore, it's 95 plus 5, which would give us 100. I mean, that was a simple computation. So the next thing to compute is the net national product at factor cost. It's important for us to know, are we doing our computations at factor cost, or are we doing them at market price? So in order to find out the net national product at factor cost, We know that this is equal to GNP at factor cost. And then we need to account for depreciation. So it's NNP equal GNP minus depreciation. So what is the purpose of the depreciation? Well, depreciation is the money that we put down routinely because the machinery that we are using is losing value and it has to be replaced. So right here we have depreciation. So going back to accounts, it's really an accounting terminology. And what we're trying to say here is if we have a taxi and the taxi is generating income for us, we need to put aside some money for wear and tear of the taxi, so for maintenance. So we're putting aside some money for maintenance. And we're also putting aside some money for replacement. In other words, once the taxi has lived out its life, it will need to be replaced if we're going to continue operating in the taxi business. So the money that is put aside for all of this is pretty much termed depreciation. So in order to find the net national product, we have the gross national product and we want to get rid of the depreciation. So we know what the GNP is. It is 100. And from that, we want to get rid of the depreciation. So let's go back to our table. And depreciation is 10. So we're going to subtract 10 and we end up with 90 being our NASH, our net national product. So this is where we will stop for part B. And please stay tuned for part C.